Hey everyone and welcome. Today we are opening up the Trader's Toolbox and taking a close look at two of the most popular gizmos out there, the RSI or Relative Strength Index and the MACD, which stands for Moving Average Convergence Divergence. You see them on charts everywhere, but what are they actually telling us? That's the million-dollar question, isn't it? And while nobody has a crystal ball, millions of traders out there are convinced that if you can learn to read a chart, you're getting pretty close. For so many of them, indicators like RSI and MACD are the secret decoder ring for figuring out what the market might do next. All right, so here's the game plan. We're going to start with the big question. Are these things a crystal ball? Then we'll get into a really key idea, leading versus lagging indicators. After that, we'll break down RSI and MACD one by one, and then we're going to hit you with a serious dose of reality before we talk about a much smarter way to think about all this. So, when we talk about technical indicators, what are we actually talking about? Well, first off, they are not magic, not at all. They're just math. They're calculations that are based entirely on a stock's past price and volume. The whole idea is to use that history to try and get a sense of where prices might be heading in the future. And that's really the core concept right there. You're not trying to see the future with perfect clarity. That's impossible. What you are doing is using data from the past to get a better handle on the market's current health, its momentum, and which way the wind might be blowing. It's all about making an educated guess, not, a prophecy. Okay, now this is a hugely important distinction that a lot of people miss. See, not all indicators do the same thing. They basically fall into one of two camps. You have your leading indicators, which try to get out ahead of the price and predict what's coming, and you have your lagging indicators, which, they lag behind to confirm what's already happened. And this right here really spells out the fundamental trade-off, right? A leading indicator can get you into a move early, which sounds great. But the catch is, they cry wolf a lot. They give a ton of false signals. A lagging indicator, on the other hand, is way more reliable. It waits for proof. The downside, you might be late to the party, missing a chunk of the move. So let's jump into our first tool, the RSI. And the RSI is a classic leading indicator. It's designed to be proactive, to try and look under the hood of a price move and give you a heads up that things might be about to change. So here's the absolute key to understanding RSI. It doesn't care so much about the price itself. It cares about the momentum behind the price. Think of it like this. The price is where a car is on the road. The RSI is its speedometer. It's telling you how fast that car is accelerating or decelerating. It gives you these incredible clues about whether a trend is running out of gas or just getting started. And this is how people put it to work. The most common way is looking for overbought readings above 70, which kind of suggests a rally might be getting tired, or oversold below 30, which could mean a sell-off is losing steam. But the real pro move is spotting divergence. That's the big red flag when the price is doing one thing, but the RSI is doing the opposite. Like maybe the price hits a new high, but the RSI makes a lower high. That's a warning sign that the momentum just isn't there anymore. All right. Let's switch gears and talk about our lagging indicator, the MACD. Now, if the RSI's job is to peek around the corner, MACD's job is to look in the rearview mirror and confirm what's already happening on the road. It's the more cautious, reactive member of the team. And really, what the MACD does is pretty simple. It just takes a short-term moving average of the price, usually the 12-day, and subtracts a longer-term one, like the 26-day. That simple calculation gives us this great visual tool that shows us the strength and direction of the current trend. For most traders using MACD, the main event they're watching for is the crossover. That's when the faster MACD line crosses over its slower signal line. A cross from below is usually seen as a bullish signal, confirming that momentum is picking up. A cross from above is bearish. But notice the word I keep using, confirming. That's its whole job. Okay, so we've got our tools, right? We have a leading indicator, the RSI, to try and anticipate moves, and we have a lagging indicator, MACD, to confirm them. So the popular strategy is, hey, let's just use both. We'll wait for both of them to scream buy or sell. It sounds like the perfect system. But here's the billion-dollar question. Does it actually work? And this quote just hits the nail on the head. See, the big problem is that both of these tools are built from the exact same ingredient, price. So of course, they're usually going to tell you the same thing, just at slightly different times. Getting 2 yes votes feels really good. It creates confidence. But it doesn't actually give you any new information or any real clarity. And if you look at the data, it gets even worse. This academic study from 2014 tested these simple trading rules on major stock indexes for 26 years, and the results were, not great. Just look at this table. These numbers are the average return you'd get from a buy and sell signal. They're all basically zero. Some are even negative. It tells you there's just no consistent edge there. And this is the painful experience that those numbers represent. It's called getting whipsawed, and if you've ever traded, you know the feeling. It's when you get that perfect buy signal, right at the very top of a move, and the market immediately crashes and stops you out for a loss. Or you sell at the exact bottom, right before a huge rally. It's incredibly frustrating, and these indicator-only strategies are famous for it. So if blindly following these signals is a recipe for disaster, should we just throw these tools in the garbage? No, absolutely not. The problem isn't the tool itself. The problem is treating the tool like a strict set of rules, instead of what it is, a helpful guide. We need to completely reframe how we think about their purpose. This slide right here is the most important takeaway of this whole thing. You have to stop thinking of indicators as a magic system that tells you when to buy or sell. Instead, start thinking of them as instruments on the dashboard of your car. They give you really valuable context about your speed and engine health, but you are still the one driving the car. They support your decisions, they don't make them for you. So here's a much smarter framework. Step 1, forget the indicators for a second. Just look at the price. What is it doing? Is it going up, down, sideways? That's your foundation. Then, step 2, you bring in an indicator like RSI for context. Does the momentum agree with the price? Step 3, you look for other clues. What's the trading volume look like? Are we near a major support or resistance level? And finally, step 4, and this is the most important one, always manage your risk. Your stop loss is the only thing that's going to save you when you're wrong. You know, at the end of the day, chasing the perfect indicator is a total trap. It just doesn't exist. The real goal is to build a smarter, more robust strategy where the price action itself is the star of the show, and indicators just play a supporting role. So the real question isn't which indicator you should use, it's how are you going to build a strategy that works for you?